Thank you very much for joining us for our panel on investing in sustainability startups. Well, we're very fortunate to have two excellent panelists with us. Amy is the founding partner of Buoyant Ventures, and Dan is a partner at Reaction Global. Let's start, if I may, by asking you just to provide some background about yourself, your fund, and what you do at your fund and your focus at this point. So maybe Dan, start with you and then go to Amy.
Sure. My background, I grew up in the house of an innovator. I was saying to Amy earlier, my father was a scientist and constantly working on all kinds of technology across just about every industry. And that was a dream to be able to go and to be an entrepreneur. So I wound up starting my career at Bloomberg and advocating to build a business there, and wound up pitching an idea to the board and getting funding for it and being able to turn it from just myself to about 500 people and $250 million annual revenue. And what I noticed, of course, was that having a brand like Bloomberg helped to open a lot of doors to be able to have the opportunities. After that, I went to Stanford's executive program, which is the summer program. And there was a lot of ambition to build something together and to do something that would be able to connect the Stanford innovators to the many people that are throughout the world, including yourselves, that could help those innovators. So think of it as a bridge between Stanford and the world and Stanford, and to play that matchmaker role. And part of the logic was to invest in things that could really drive change, where you might be a user of Google, you never had to meet the founders, Larry and Sergey, but if you're using a health technology or climate technology or an education technology, that really involves a lot of the right relationships, which of course this community brings. So we built first a community and then a fund and then connected the two. And that's what I've been focused on. When Stanford opened up their new school of sustainability, the Door School, well, that's a perfect example. Those types of innovations definitely need this community, and this community needs those innovations. So that's a great area to focus. And it's been incredible to see Stanford's commitment there and progress since.
Thank you, Amy.
Great. It's a real pleasure to be here. Thanks for having me. I was an undergrad at Stanford. I run Buoyant Ventures, which is a climate tech venture fund. We invest in early stage companies that can help to decarbonize or help with resiliency. And our focus is on seed and Series A and digital climate solutions. So we invest in software and what we say is simple hardware that can help meet those climate goals. So we're not taking on a lot of the heavy scientific development work around battery chemistries or carbon capture or anything like that, anything that requires a lot of manufacturing. These are for the most part software businesses, a lot of AI in our portfolio. And I've been in the climate space for 20 years. So prior to this, I had started another fund called ex-Energize Ventures here in Chicago. And prior to that, I started a technology accelerator, which is now called Evergreen Climate Innovations. And they fund a lot of the deep tech companies. And so that's how I got to see firsthand what that development cycle was like, how much capital it required, and why we focused with the venture fund on digital solutions. And then earlier in my career, I spent 20 years in California before moving back to the Midwest, where I grew up to raise my family. I have 2 college-age daughters. And after Stanford, I worked in the high-tech industry, and I built and sold a consumer technology company that Paul Allen had funded. Have been both an entrepreneur and an investor, and I'm investing in climate because I feel really deeply that I want to be doing something that has deep purpose and meaning to me, and I want to try to make a dent in this sort of global crisis. I'm able to and try to make things a little better for my daughters and their kids and future generations.
Fantastic. Thank you. Definitely deep expertise with both of you. Let me start out with a question that's a difficult one in a sense, but probably on everyone's mind. Given the current geopolitical situation, what do you see happening in climate and climate tech investing over the next 3 or 4 years? Amy, and then Dan?
Sure. It's certainly a rough time, I'll tell you that, where there's a lot of all the volatility that's happening now in the US, in the Trump administration, all the volatility in the stock market is not good for investors. When this is happening, investors tend to pull back. And we do have money. We have $83 million under management in our fund. We will be needing to raise a second fund. And believe me, I'm talking to folks every day, and the market is really rough out there, right? Folks are nervous. And I think from a climate standpoint, They are also watching what is happening at the federal level and worrying about some, not just pullback from investors, but other headwinds that are going to arise from some of these actions that are happening, but reduction in funding, rollback of some of the policies that the EPA has, that trying to dismantle some of the agencies that do a lot of work in this space. So I have been talking to investors in Europe, and I'll just say very briefly that I think there's a lot of opportunity still in Europe because there are some better rules and regulations there, but they're not immune to a lot of the volatility that is happening now in the US. And climate is obviously a global crisis, and we need companies that can be deployed at a global level. All of our companies aim to be global businesses, even if they primarily start in the US. And we'll need capital around the world to really scale up and address this problem in any meaningful way. But we're hopeful that maybe for our fund that we might find some more co-investors in Europe who are going to maybe stay the course while the US is pulling back.
Thank you. Ben?
Yeah, I'd agree with that Amy said. There's a book that was written a long time ago, actually in 1907, so it's not like a recent bestseller, called The Pitfalls of Market Speculation. And all the data up to that point suggested that when the market is high, people buy at the top of the market. So 90% of the buying is at the top of the market. And when the market goes down, they tend to say, I don't want to lose more. They don't want to miss out on the top side. I don't want to lose more on the bottom side. And so they tend to do 90% of their selling at the bottom of the market. And so you see that panic and fear right now that the market is going down. People are going to pull back. And so they're hesitant to go into anything. But on the geopolitical side, of course, companies before, Amy wisely said, the manufacturing, where there's a long, very capital intensive, unpredictable outcome in terms of what these companies are doing, and they can depend on grant funding and so forth. Those business models are going to be very tough. Looking for the companies that have a business model that makes their customers more profitable, makes their customers more marketable, can weather the storm, and they'll be good companies and they'll make good returns because this is a good time to buy. This is a rationalized market, and you'll have upside on the other side of it, but only for companies that really have a smart business model and can be successful regardless of what the federal government does and not depend on it.
Really helpful. Thank you. If we begin to narrow down a little bit, what are some of the key themes or trends that you would look at as investors? Because Stanford Angels Entrepreneurs, primarily angels today, probably. So are there some sectors that you see or themes that you see or trends that you're focusing on, or just still looking very broadly? Dan, then Amy?
It's a bit of a oversaid word, but AI is certainly an area that people are focused on. As one example, we invested in a company called Swipe, and this is a wonderful story. It actually was not a Stanford company. It was three guys from Argentina that did a business program or technology program in Canada. And off the back of that, they were hired by Jamaica to fix their energy grid. And naturally had all kinds of issues. And they realized that the congestion is causing so much of the energy that could be produced and could be put onto the grid to not get where it needs to go and not get sold. And if you could solve that problem, it unleashed 50 to 100% more revenue and energy, and in this case, clean energy. But it involves making 60,000 decisions per second in order to be able to completely uncongest the grid. So they went out and they fixed the problem in Jamaica and then built it in a way where basically they're replicating all of the different pieces with a digital twin, whether it's a wind farm or a solar farm or a hydro farm or even a coal electric plant, replicating that and then looking at all of the different customers that they have and then building algorithms on top and a UI, which suggests movements until the companies get comfortable just accepting it and putting an autopilot. And that's when they really get 50 to 100% more. So to the point about business models that make sense and make the companies more profitable and more scalable, this is one where they raised at 40 million and now they're raising at 350 million one round later. So that kind of trend of using it in a way that's digital, but also in this case, it's very physical because they have to connect to all of the actual physical assets was, I'd say, one of the trends that we've seen. We were also talking about an insurance company where insurance companies historically have made a lot of mistakes on their risk assessments because they're using very old sets of data. And being able to come in and use drones and use AI to be able to calculate risk in a different way has allowed them to predict which policies to write and which policies to avoid in terms of catastrophic insurance, and been very successful in building credibility in that. So that company was called Future Proof. And as we were mentioning, using AI and then building a model that's superior model and then being able to expand that and scale that into our carrier is specifically for climate insurance is a great business model that will thrive even if the federal government doesn't support them.
Sure. I think that's sounds like Dan and I need to be friends, okay? Because he's looking at a lot of related companies and vice versa. So we're particularly interested in this digital focus for all the reasons that Dan described, right? These are businesses that are delivering some kind of core business value, either improved profitability, reduced cost, improved yield or productivity, simplifying things, automating things. And so we describe that as vertical AI, which is usually a company that is targeting a particular industry and using that industry or that company's data in some kind of AI model, and then aiming for some business value as a result of that. And in our case, probably the two of the stronger companies in our portfolio, I would describe as vertical AI companies, where they began with a model and then they built more of a full stack software solution around that model to drive even greater benefits to their customers. So one company in that space is called Raptor Maps. It's a solar software company. So similar to what Dan says, this intersection of software and physical infrastructure, they began life they spun out of MIT. They took drones and flew them over solar farms and then took the video footage from the drones and then analyzed it to produce recommendations to improve the productivity from the solar equipment. And they built that into a business that involves many other benefits and workflow improvements for the solar operators. And we've been in that company now for 4 years, and they're doing quite well. And they've got some good revenue growth, and they're servicing utilities, owners, operators, developers, and engineering firms, primarily in North America, but also expanding globally. And then another company that I would describe as a vertical AI company is one called H-Data. And they're using large language models and some proprietary technology to allow energy customers to search these very dense regulatory filings for information that they need when they're filing a rate case, maybe when they're making an investment decision. And it's very hard. It usually costs a lot of money, and a lot of attorneys specialized time to weed through these documents. But this is a very good application of large language models and being able to perform natural search queries of these dense filings and get results and feedback very quickly. And like Raptor Maps, they started out with this and they're building more features and functionality onto that and selling that to utilities, consultants, investors, and they're doing quite well too. So we'd love to make more investments like those kinds of businesses that are using some of these latest innovations in AI and applying them to a particular industry use case where there can be some very tangible business benefits.
Yes. Dan, just a quick question from the Q&A. What's the name of the Jamaica grid startup? The person missed it as you were speaking.
Yeah, it's Splight, SPLIGHT, and their website is splight-ai.com.
Everything's AI these days. Exactly. Thank you. Next, are there some sectors that you see that are particularly attractive or particularly unattractive? Go back a couple of years and there was a lot around plant-based food. There's a lot of money going into EVs, or there has been. But are there some sectors in particular that you're looking at as attractive or unattractive? Start Amy and then Dan.
Sure. One area we're very excited about is maybe broadly defined as green computing. And that's trying to make computing itself less energy intensive and trying to help decarbonize that. And so that might be identifying ways to reduce the energy intensity of the training of the models, of the storing of the data, of interconnecting those data centers themselves to the grid, powering them with clean energy. So we think there's going to be a lot of appetite from big tech companies as well as data center builders and managers. And just in general, as more and more companies move to AI, there's going to be a need for folks to figure out how to make all of this computing much more efficient. So that's one area we're very excited about. We've done some proprietary research in that area, and we have one investment in that space, which is a database software company called Ocient. in Chicago, and their database solution uses much fewer servers and resources to do the analysis and the queries of big data. And then I think an area that we're relatively bearish on is still, and we've had this position for a while and we keep reevaluating, but we haven't gotten comfortable to want to move into it, is carbon markets. And so I know there was a lot of excitement in the past few years around trying to create some kind of revenue around carbon credit trading for some companies that had carbon benefits. And we were always very concerned about the voluntary markets being flooded with low quality reductions in credits. And that has proven out to be true. And because we're digital, we would see a lot of folks that were pitching marketplaces or verification tools and things like that. And we've pretty much stayed away. And I think that has been a good decision. And within the carbon market space, we do what we're seeing with some of the enhanced rock weathering and some very efficient ways to sink carbon. But we've been always very skeptical of the energy intensity and costs of carbon removal, as well as some of the forestry projects, which maybe haven't really produced the kind of results that everybody had hoped for.
Yeah, exactly. Dan?
Yeah, with Amy on the carbon removal, we looked at the company called Teradot. We did not invest yet, but I know they have a lot of very big investor names. I'm with you on the plant-based foods. So we've made, I think, 24 investments and had 2 failures. One was because the founders fell out with each other, not because of the business model. They were succeeding otherwise. And the other one that went to zero was a plant-based company. And you do see thousands of versions of that. And even the Impossible Burger, which is the famous Stanford innovation, is at a pretty low multiple now and struggling, and the kind of nutrient points. You need about 3 Impossible Burgers to get the same protein as one regular burger. And so people are, outside of vegetarians, are not really embracing it. And a lot of these brands are consolidating. We did find an alternative to that in a company called Golly, which grows cotton in a lab. And cotton is a really dirty crop and problematic crop, right? The amount of water that gets consumed is in the thousands of liters per pound of cotton. But the bigger problem with it, and obviously pesticides and emissions and everything that goes with it and the labor conditions, the bigger problem is that because of climate change, about half the cotton grown today won't be able to be grown by 2040. And so you wind up having a supply chain issue. And so they've figured out that the only ones that have figured out how to grow it 10 times faster with a fraction of the water without any need for land and very limited emissions, no need for pesticides because it's grown into a lab. And they've got John Doerr, Bill Gates, and Breakthrough, and a number of big investors behind them. So we see that as something that is a huge market and huge opportunity, even though, to Amy's point, it does involve manufacturing, and to scale, it will be very capital intensive.
Sure. Okay, thank you. Angel investing, even some of the VC investing, seems to have slowed. Talk to founders, and it's harder to get capital in whether you're in US or other markets. What do you see as the situation? Do you see investments picking up again, funding becoming more available, becoming less available? What kind of trends are you seeing? Maybe Dan and then Amy, in terms of capital investments that the founders can expect.
I'm definitely seeing a slowdown in capital availability, and it's partly because the human sentiment to look at when a market goes down, when a price goes down, you want to wait and get your money out. When M&A drives up, you don't see as many exits, and so you're holding on as opposed to putting more in. On the other side, it's a great time to invest because the market is rationalized compared to 2020, 2021, when it was a bubble and everything burst, and then we've had this 3-year stall period. It's a great time to get in and have the upside when the market recovers. So yeah, I see less capital availability and people just by nature holding their money close because they're more interested in getting something back before they put something more in. And I understand that, but it's the opposite psychology that makes sense in terms of when to expect returns. The number one factor for a venture fund in terms of success is the year. And so these are, I think, good years to be launching a fund, even though they're very tough years to be raising a fund.
Better go back and read that 1907 book you mentioned.
Yeah.
Yeah, pitfalls of market speculation.
There we go. Amy?
I think very well said, Dan. So I think all I would add is that we're actually doing our annual investor letter. So I have some relatively current data on this. And in 2024, there was about $30 billion that was deployed into the climate space, which was about 14% less than the previous year. So there was a slight decline, but there was a very dramatic decline in growth stage investing. So you've heard about all these funds that are raising more later stage venture funding, but they're not deploying. And so there was a 38% decline in growth stage venture investing for climate in 2024 over 2023. And we've definitely seen that because we do seed and Series A, and it's very hard to find those follow-on investors. Even though we know they exist, even though we know they have dry powder, they've just been very careful what decisions they're making. They're putting very high expectations on any of the companies that they're investing in. For instance, a Series A company for us 4 years ago would have been about $1 million of revenue. Nowadays, like to get a good Series A done, you have to have $2 million of revenue. One of our better companies is going to be going out for a Series B next year, and they're going to be going out like at $8 million revenue instead of $5 or $6 million revenue. So because they have to look healthier and stronger to attract those larger funds. So I'd say for your angel investors, I totally agree with Dan that it's a good time to find deals and to get into these companies. The only problem is that even though we know there's money in the funds and the institutional funds that should be able to do the follow-on and continuing investing, they are not deploying at the rate needed to help those companies grow and thrive. So you're seeing a lot of bridge rounds right now in our portfolio and others. We actually are investing in bridge rounds because we believe the companies will make it through this correction, and it's a good time to get in and with some favorable terms, and then hope that bridge funding will enable that company to make it to the next stage and raise a really healthy round at the next stage. So that's just some of what's happening in the space. But I guess I would highly recommend for any of your angel investors, if they're not already in a fund, a lot of funds create co-investment opportunities for their, I don't know, Dan, if you guys do that, but we do that a lot. So especially when we lead a deal, if we're able to get an allocation for our LPs to invest alongside of us, it's a good way as an angel investor to leverage the diligence of the fund. For instance, we share our investment memos and our diligence, and I think that's not uncommon at funds, but I think that's a good way to kind of maybe take advantage of some of the folks that all day long are looking at the market, looking at companies, following these trends, like getting inside scoop on what the prospects are for some of these businesses. So I think that's a good way to protect maybe your interest in this next few years.
Good insights. Thank you. Let me ask a question that's more Stanford specific. And Dan, I know you especially deal with Stanford, and Amy, I'm not sure. There's the Door School has started up. It's moving along, focused on sustainability. There are other groups, Stanford Alumni and Sustainability, and the Stanford Students for Sustainability, and a number of groups there. There's a startup lab. Are you seeing things come out of Stanford in particular, since this is a Stanford group, that are innovations that you're interested in, or seeing some expansion of that, especially after the Door School started? Dan, we'll ask you, and then Amy, if you have thoughts on it too, great.
Yeah, I think a bit of a history. I may have it wrong, but I think the initial date for the Stanford School of Earth was 1947. And then they continued to iterate and iterate. Most people know the Tomcat Center, which is Tom Steyer and Kat Taylor, and they kept on adding to it. So the Door School is an additional progression from a largest of its kind donation. I think it's the second largest after Mike Bloomberg's to John Hopkins, but a very large donation, not just from John Doerr, but also from the Yahoo founders and other alumni, that put a couple $2 billion into creating a new campus, new buildings, and really taking all the little bits and pieces that were all over Stanford and the 6 schools before that and making it a formal school. We've seen a lot of the top people from GSB and engineering move over into the Door School and just become a bit more of the hub. And they talk about it. It's now 8 things. And there's the School of Sustainability, and then there's the Sustainability Accelerator, and putting a lot of resources and a lot of focus, not just at Stanford, but around the world, to collect data and to be able to run a lot of interesting analysis. But back to your question, are we seeing interesting things? We had one very good story before the Door Store was launched with a company called Antora, which does thermal energy. Think of a steel plant that is running on coal, and coal is, especially now, unpredictable in terms of cost, and it's terrible for the environment. It's not marketable. The cost of storage was so high that it would be unprofitable to make any switch. And they figured out how to do it with carbon blocks as opposed to lithium ion and so forth. That was about 100 times cheaper. Long story short, you go to the steel company, they can run their manufacturing with more predictability, with more profitability, with more marketability. And that's another business model. Even though it is manufacturing at scale, the engineers have figured out how to do that manufacturing at scale, going from one battery per month to 3 per month per location to 5 per month per location to multiple locations, and just keep on cranking up the dial in terms of the manufacturing. That company started at 6 million when our GPs initially invested, and was at $500 million at the end of last year, which was dramatically undervalued because they won a IRA credit that will add several billion to their expected revenue over the next 6 years. Anyways, yes, things like that, if you can discover them early and get in cheap, and help them to scale and help make introductions to the right companies. We introduced them to an energy company in Europe there that's run by 2 Stanford guys, and looks like an entry for them into Europe. That's great. But most of the things we see now through the Stanford Sustainability Investment Group and so forth, and in the labs, they're super early stage. And it's not necessarily something we're going to jump on investing, but wanting to build a relationship and understand and watch and look for the ones that really gain traction, and then jump on those with an existing relationship instead of starting from scratch and just seeing a PowerPoint for the first time and trying to figure out if it's real.
I would just add that one of our LPs is Jane Woodward, who is a professor at Stanford and teaches a course with Dave Danielson that helps students come up with business plans around climate technologies. And they've had really great, I think that's a great course. And I think it's great for your audience to track what they're doing and which companies are coming out of that, because I think they get some excellent instruction and mentorship. And we've been a mentor in the past to some of the companies there. And then I would also say we have to help give us eyes and ears on the campus, we recruited a Stanford Scout who's an MBA student. And his name is Josh Cohen. He's actually graduating this spring, but he's been working with us for the last year and a half, helping us to see what would fit our thesis that's being developed on campus, and has also just help us make connections with students who might be interns for us, because we have a really robust internship program where we hire MBAs to work with us throughout the year to help screen deals, help build diligence memos, and they've been really excellent. And we've had some great folks from Stanford participate in that. Big fan of what everybody's doing there, and I'm so excited to see that level of investment come into the university, because there's some great talent there. So hopefully we need these young, inspired people to come up with these solutions. I always say when things are getting really dark and not looking so optimistic, I just always say young people are going to save us, whether they're like the PhDs and graduating scientists who are coming up with ideas or helping to try to get their science out to market, or students that are coming up with business ideas that have this passion. I really feel like there's so much ingenuity at our fingertips, and we just have to figure out ways to support them and fund them so they can grow their businesses step by step.
Fantastic. One question, and this is more for angels, so I'm not sure you'll be able to answer it exactly. One of the things some of the angels look at is, I want to invest, but I also want to work with the company, help the company informally, formally, whatever else. And so my experience is, if you ask companies, the startups, what they need, they say, oh, we need money and we need sales leads. And that's about it. So we got people with technology, marketing, finance, whatever else. What do you see that the startups actually need? And are there opportunities for angel investors or for your team to help the founders of the companies? Maybe Amy and then Dan.
Yeah, totally think that people with all backgrounds can support these companies. And I'd say the biggest thing, if you're not working on the development of the solution, the technology, then they need salespeople. Okay, so they need folks that will make commercial introductions for them. So if you're an angel that happens to have experience in a network within that field that they're targeting, then you might be able to help open some doors, and maybe you could be an advisor to them. Like a lot of startups, a number of our startups have created advisory boards so they can get insights from folks outside the company who aren't necessarily investors, but might have something to add either in market insight or technical expertise, or most likely commercial relationships. So that's like really maybe the best thing that you can do to help these businesses. And I would even say that many of the companies really struggle with, in the beginning, it's like founder-led sales, but they really struggle to staff that sales function. It's really hard to hire a head of sales after the founder that works out well. What, for whatever reason, they don't get the fit right and they have to try again. And that's happened for many of the companies in our portfolio. If you happen to also be a good salesperson or know a good salesperson, again, like that's really needed at these companies and sometimes there's a need to hire somebody part-time because they may not be able to offer full-time to someone. So whether it's as an advisor or maybe as a part-time person, that's certainly a way that you could help.
Great. I do see that gap in sales too. So a key area. Dan?
Yeah, no, I'd echo everything that Amy said, but that was the philosophy, quite honestly, behind Reaction. Was you saw some of the incredible entrepreneurs that Stanford brought to the classes, and you got to meet them, you got to learn about their journeys and what they were doing, and wanting to get involved, wanting to be hands-on, and wanting to invest in them, and so that you could not just help but be part of the outcome. And that kind of led to the idea that, hey, we have a network of networks and a very global group that, as I always inappropriately joke, they needed me as one white American guy for diversity in the class because everyone was from 50 different countries. But that essentially is all individuals with Reaction. We are a bunch of leaders, 64% are founders or CEOs, and all throughout different markets, different industries. It's a great group to be able to pair up with the companies. I mentioned Splight and Futureproof as a couple of examples earlier. We're having an event with them next month. If the group here wants to join, they're very welcome. And we have a Stanford lawyer who is also going to comment on navigating climate policy in the current geopolitical conditions. So happy to share details on that.
Great. Quick follow-up question is, if someone is advising one of the startups, do you know how they're compensated at all?
Sure, definitely, yeah. It varies. Usually they get a small option grant from the company. So they don't normally have cash because they're very cash constrained. They probably would pay any expenses that the advisor would incur, but they don't necessarily pay a consulting fee. So they would typically compensate the advisors with an equity grant that might be 0.5%, or depending on how much value you're adding, like 1% of equity in the form of options that would vest over a period of time. So again, they want to make sure that it's a good fit with the advisor and that they're able to get some real value out of working with them. So they maybe vests over a few years, 2 or 3 years, whatever the term of the advisor role is.
Sure. Great, thank you. There are several questions in the Q&A and then also submitted earlier. One question is, Trump has asked DOE and other places to take the word sustainability from all funded projects. The question is, how is Stanford responding to this development? And none of us can talk on behalf of Stanford. But I would ask, how are some of the startups positioning themselves, and are they shifting what they talk about or how they talk about things related to sustainability in the current environment? Dan, then Amy?
One thing that Stanford's done is they appointed Arun Majumdar as the dean of the sustainability school, and he's connected with the energy secretary of the U.S. At least last I checked, he was. It may have changed since Trump came in. So I think Stanford is very much trying to connect themselves to Washington and play a role in terms of influence, and not just influence, but as an advisor to Washington in terms of the data and the technology and the different innovations that are there. But Stanford, like everyone, we're fairly powerless against what's happening in Washington. The best thing you can do is to build innovations that have the right business models and can make a difference regardless of what Washington does. It doesn't depend on them. And at the same time, try to influence or lobby for participation there if you can get it.
Just a follow-up, are you seeing the startups change their wording or their focus in pitches or things like that? Taking out climate, taking out sustainability, substituting, something like that. The mega companies have done that. Are you seeing that at all on the startup side?
Yeah, we definitely are. Yeah, for sure. I think that energy security is a big replacement phrase. Energy transition is a replacement phrase. Cost savings, anything around savings or efficiency is being talked about. People are using the term American energy dominance, although I think that's a little goofy. But anyways, yes, that is big. People are definitely changing their language. And I think that part of the issue is depending on what, do you need that funding? So to the question on taking sustainability out, a lot of grant funding has been canceled or is being frozen, right? So that's really harming a lot of these businesses that relied upon that funding. Dan mentioned this earlier, like how are they replacing that? I don't think any language is going to change that for them. So I think that you're having to really figure out, like, can you find money in the public markets? Can you find philanthropic capital? Can you find money at the state level for what you're doing so that you can still maybe get investment into your pilot programs or your production facilities? Because that was really the biggest loss, right? Was that scale up money that was coming out of the federal government and all the loan program office loans. So I think that, and it's just a few comments on that, but yes, people are definitely changing their language to try to be more appealing. And then I think the issue, we've purposely not changed our language around what we were formed as a fund to invest in climate solutions. So we're actually not changing it. We're like, this is why we were created. And so even though you want to change the language and erase it, it doesn't make climate change go away. And so we do, though, have a lot of scrutiny on, as Dan said, companies that are able to offer something that businesses will pay for that has a clear ROI that is not climate impact just for climate impact's sake. So that's really a critical focus of ours. And then trying to ride which of those trends are going to be ones that will fuel these businesses regardless of politics and administrations.
Great, thank you.
I'd also add on, you think of sustainability as turning mushrooms into leather or plant-based food, and that the kind of obvious things. But there's some really radical business models that seemingly have nothing to do with sustainability, but make a much bigger impact in terms of the energy reduction. One that we looked at is some of the people here in the US know Fresh Direct as a brand, and the idea of being able to go direct to a manufacturer. And if you look at where emissions are, something like 40% is in real estate and 10-15% is in transportation. And the way that an Amazon worked, for example, or a Costco works, you have so many different warehouses and shipping parameters that if you could just go and buy it direct from the manufacturer and get it sent direct to your house, you're cutting out 80% of that shipping and those warehouses, that real estate, 80% of the carbon footprint. Even though at the end of the day, you want to buy a cheaper whatever, cheaper TV, a cheaper stove, a cheaper tennis racket, whatever it might be, and the manufacturer wants to sell direct to the consumer and not have all these middlemen that are taking the profit from them. So it's a good business model, but there's a huge climate impact when you do that at scale. That even though it's a very capitalistic business model, still makes a bigger difference than a lot of the, I hate to say, feel-good innovations that are great, very cool companies, but very low scale.
Thank you. Another question from the audience, narrowly focused in one way. What types of solutions or technology have you seen to make data centers more sustainable? This goes back to what you said about AI, and everything is AI these days, which requires the data centers. But are you seeing things around that at all? Maybe Amy, then Dan?
Yeah, folks are definitely trying to power the data centers with clean energy. So that's one thing, right? They're looking for sort of low carbon or carbon-free energy supply for these data centers. They're trying to they're doing something which is called bring your own power, where they're trying to bring clean power to the data centers themselves to act as a power source in addition to the grid interconnection. And there's certain tech companies that still have pretty high standards and net zero commitments for their own businesses. So they want to actually work with folks that can power those data centers on clean energy so that they can count that as towards their net zero goals. So Microsoft is our largest investor and they have a very serious commitment there. So they're looking for partners that can be using cleaner sources of energy for their data centers. So I think that's one area for sure. Another area is just in some of the management of the power supply. So In certain data centers, especially in crypto and in some of the crypto mining areas, you can actually throttle back the energy consumption of some of those data centers to when energy may be cheaper or also maybe cleaner. So there is some sort of grid management solutions that are being rolled out for some of these data centers. It's a little harder with AI, and that's a little bit harder to say we're going to throttle back kind of your energy supply or reduce the amount of queries that you'll take because you're trying to like either train that model and you're running that all day long. But even in some of the model training can be done during off-peak times or in the evening. So if it depends on if it's something that is customer facing and working more on the queries and the inferences versus in the model training, you can do some of that at better times on the grid when you have more clean energy or when you have cheaper energy. So those are some of the ways that we've been looking at this. And then again, like at the software side of things, creating code that just runs much more efficiently. So a lot of times when you're doing data analytics, you're replicating the data set, and that's what ends up eating up so much computing power, so that when you're actually running queries or trying to get information out of that data set, you've made it so energy intensive and compute intensive because you've had to replicate it. And that's just getting harder and harder to do as these data sets get larger and larger. Back to this company, Ocean, and looking at a few others who are figuring out, okay, how can we actually run queries on this data without replicating it, making that a little bit more efficient. So that's attacking it at a fundamental sort of software stage.
Yeah, I agree with everything Amy said, and I'd add in that the data centers that you see today will look nothing like they'll be in 10 years from now, because you've got this wave of AI, you've got this wave of quantum following AI. The speed of computation, the speed of transmission will need to be light speed, literally, and have completely different hardware to be able to facilitate that. I remember when I was at Bloomberg when September 11th happened, and Merrill Lynch at that point had their primary data center in World Trade 1 and their backup data center in World Trade 2, and had no data centers because they had to keep in so close proximity. And now you can do 60 nautical miles and so forth. You spread them out to prevent that. But the speed that you will need at that distance or at any distance will be dramatically different. And being able to figure out how to do that and not fall behind and take advantage of the next waves of technology, but also not destroy the planet in terms of faster chips, faster transmission, faster everything, will be a super big challenge and probably ethical debate around the advantages that you're creating for yourself, but also the damage that potentially you're doing by creating those advantages.
Let me add one thing I thought of, Richard, that I should mention is that we might recall a few weeks ago, DeepSeek came on the scene and showed that they were able to train their model using older chips, fewer computers. And so I think that was a real call to action for some of the US companies who are just saying, I need all the latest and greatest chips and I need as much power as I can possibly get. And so I think there are more efficient ways to do this, okay? And so efficiency is really born out of necessity. And so I think that there's some hopefulness there is looking at ways that we don't necessarily have to have this infinite supply of energy for this industry to grow, that we can find some efficiencies in how to do this. And the one thing I'd say politically that is a little mind-boggling and worrisome to us is this idea that the federal administration would want to play favorites with any of the types of sources of energy, because if we're entering a period of projected load growth, and we haven't had that for decades, okay? All of the innovation and efficiency has allowed our modern society to grow without necessarily expanding or increasing the energy demands of the grid and the generating assets. But now all of this innovation in AI is causing the load growth to grow beyond what we have the means of producing energy for. So you really are going to need every form of generation to do that. And right now, the fastest way to satisfy that energy load is solar plus storage. It takes 2 years to build one of those facilities. So if you're trying to bring your own power and you want to have some on-site generation, solar plus storage, not only is it not carbon emitting, but it's also the fastest to build. It takes about 4 to 5 years for a gas plant because of the supply chain constraints, and it takes over 10 years to build a nuclear plant, and that energy is very expensive when it's done. when they're done building it. You hope that the market economics will win out because in that case, renewables are very well positioned, and that we hope that the administration won't impair some of that very rational ways to satisfy the energy demands.
Nice, thank you. You've now given me a new acronym too, BYOP, bring your own power. Another question from one of the participants is, how do you measure the sustainability impact of a startup? Let me expand on that a little bit, because what I see is they'll have some kind of something in their pitch deck of here's how much carbon we're going to save or water we're going to do or whatever. And then I also talk to companies that are doing things that are massively sustainable, but they don't even realize it themselves. And it's reducing energy and manufacturing or whatever it may be, or wastage or something. So you want them to become the billion-dollar company, but how do you measure the sustainability impact when you're looking at these companies? So Amy, then Dan.
Sure, we actually discuss that before we make an investment, and we write that into our investment docs. And so there's usually like a few metrics that are core to their operations that we can measure and then aggregate with our other companies. We put into an annual impact report. And it isn't one single metric because we focus on decarbonization and resiliency. So on the decarb side, it might be the amount of, for instance, our company Raptor Maps, like they're servicing a certain amount of certain gigawatts of solar energy. And so their solution can improve the output from that solar equipment. So we can measure that and we can calculate what a carbon benefit is of that few percentage points better production or optimization on the equipment. In other cases, we've got a company that is a secondhand clothing software solution called Benny, and they're helping to spur people to shop for secondhand items a little bit more easily. And so that diversion of a certain amount of clothing going into the landfills, you can turn that into a calculation on the reduction in carbon emissions as well as a reduction in water and recycling and waste from that new purchases. So we'll do like some calculations there. There's usually something that you can wrap your hands around and compute something very logically. In the case of the resiliency side of things, we'll look at lives and livelihoods covered or the value of risk. In the case of the insurance company that Dan mentioned in Future Proof, you could calculate, okay, here's what level of risks we've covered. And so you could put a financial number on that. You could put a number of people, like communities that you've covered there. So those are some of the metrics that we would measure.
Thank you. Dan?
Yeah, I agree with everything that Amy said, and I don't know where's as far along as she is. The only comment I'd say is we get a drastically different set of information from different companies. On the Continental Lab company, we get 30 pages of OKRs, maybe because John Doerr was a foundational investor. Every quarter, that's details. And then some of the other companies, you get nothing until they're ready to raise capital, and then they give you the pitch of what it could be, selling you the dream. So it's all over the place, and normalizing it is very hard.
Thank you. We're going to put a summary together for our next newsletter, which will be coming out in the second quarter. Dan and Amy, you've given us phenomenal insights today on what to do as angel investors in this sector. What are some of the themes and what's coming up next? So thank you very much for joining us today. We really appreciate it. For everyone who attended, thank you for coming. We hope you found insights as well. Feel free to contact Sheila or me if you have questions. We can relay them along to Dan and Amy. But Dan and Amy, thank you very much for spending your evening with us.
Thank you for having us.
For having us.
Thanks. Great. Thanks, everyone.